first, let me start with the point really to understand the importance of Russia from global perspective to really understand impact of current crisis on global as well as Indian economy. Russia is a very major player in global trade, particularly as far as the commodities goes. So Russia accounts for almost 12% of global oil supply and around 17-18% of the natural gas supply. So clearly, ongoing crisis has clearly dislocated supply, and hence we have seen a pretty sharp rise in basically energy prices worldwide. And clearly, I mean, if let's say things has to sustain where it is, unfortunately, going forward, if you look into cost of energy into, let's say, certain European countries is trending at around 7-8% plus of the GDP. So that is clearly a worrying sign, and historically we have seen when some of these things do happen, clearly coincides with clear-cut demand destruction. So to that extent, I mean, that remains an immediate worry. India, as such, direct reliance on Russia is low. I mean, relatively from the overall trade standpoint. But given a global demand supply imbalance, clearly the overall prices, I mean, particularly the energy prices are shooting up. And at current prices, and unfortunately, India do rely heavily onto the imports as far as this entire energy basket goes. So at current prices, if we look into, we are looking at, I mean, energy import bill could rise by around 70 to 100 billion dollars, somewhere into this particular range, which is more than 2% of the GDP. So this we are talking, if let's say the spot price of around $120 sort of a price of crude to sustain, we have to pay I mean, additional by around somewhere in the range of 70 to 100 billion dollar for fiscal year 23 versus what has been in case of fiscal year 22. So which is a very big number. At the end of the day, because this is the amount going out of the country, so to that extent, I mean, the GDP growth and the entire consumption also going to get impacted. But on your point of who is going to fund this particular bill, one is clearly from the government point of view, there is overall, I mean, some sort of a space is there, because if we look into the excise taxation on the crude basket, petrol, diesels, and all versus pre-pandemic, they are still on to the higher side. So to that extent, if let's say that excise duty has to revert back to what it was during pre-pandemic, around 20 odd billion-dollar can be funded by just way of reducing that particular
Okay.
sort of a excise duty. So which in a way itself, that lower revenue to the tune of 20 odd billion-dollar for the government. And then obviously over and above, I mean, everything is going to flow down onto the consumer, right? Because this is one particular line item basket. If let's say companies are going to get impacted because of the higher RM, obviously they are going to pass it on to the consumer, right? So beyond, I think this 20 odd billion-dollar, which maybe government might have that much sort of a headroom just purely on account of, if let's say excise duties has to revert back to the pre-pandemic level, rest everything has to be funded by the end consumer. Let me just give you some more data points before really coming on to your question of the market side, that purely on account of the shift in energy prices and all, how it can really impact the GDP growth and then inflation and all that. So clearly every $10 per barrel sort of increase do impact GDP growth by 35 to 40 bips. So that, to my which pretty much also tally with the number which I said earlier, that 70 billion-dollar plus sort of a I mean higher bill. And all of these, obviously we are assuming that crude is going to sustain $120 in I mean, which might not sustain also, given let's say if things has to settle sooner. And also every 10% increase in crude also do impact CPI basket by bips directly, plus indirect benefit, plus indirect impact is over and above this in the form of higher transportation cost and all of that. So net, and also current account deficit, which has been very, very favorable, that is also obviously going to impact by 40 odd bips with every $10 sort of increase. So some of these macro data points clearly is going to get impacted if things remaining where it is. Now, coming on to your point of markets, and obviously earnings is the first data points to really look into, because market is clearly a function of how the earnings growth is going to pan out. So if we look into overall earnings growth, clearly we have to bifurcate it more at the sectoral level, because let's say higher commodity prices, there might be certain sectors which in fact might get benefit in terms of earnings. Let's say sectors like metals or maybe oil and gas upstream, downstream obviously is going to get impacted. So some of these sectors are in fact might be positively beneficiary to that extent. But there are also other sectors like B2B businesses, IT and all has literally nothing to do with higher crude oil prices and all. In fact, if currency has to depreciate, some of these exporters might benefit, I mean, as far as their earnings goes. Similarly, is the banks and financial services, I mean, no direct sort of impact on banks earnings, but obviously if some of these things has to sustain, if let's say demand destruction has to happen, which might have some sort of impact on the overall credit growth. So to that extent, there might be some impact, but we don't see that there will be a very meaningful earning downtick in some of these sectors which I mentioned, like banks, IT, so is pharma, metals, telecom, and oil and gas, I mean upstream. But obviously, there will be a very big impact on B2C businesses like autos, as you rightly said, that there will be a very heavy sort of a cost pressure. Apart from this, obviously, consumer staples, discretionary, some of these sectors are also going to get impacted. Cement, for that matter, wherever the input is crude linked to a great extent, I think crude or maybe metal linked. So some of these areas are obviously going to get impacted, and we'll see downward revision into the earnings. So so again, I mean, coming on to your point of how the market is going to pan out, one, we have to really dissect the sectoral level, that where the impact is higher, where the impact is lower. That is one aspect of it, and then obviously everything has to be looked from the lenses of the valuations. I mean, even after correction, if you really look into just purely on 1 year forward earnings basis, let's say large caps are at around 19x 1 year forward valuation, which has now really come at, let's say, last 10-year average. 1 year forward earning is also for large caps is at around same level. So to that extent, clearly, whatever premium in historical context markets were trading at, particularly for large caps, that has now revert back to the median sort of a multiple. Second, mid caps, if we look into, is still at a premium to their historical average, is at around 20-21x 1 year forward, and versus historical average, let's say, at around 18 odd times. So mid caps in current context are still trading at higher valuations versus historical context, versus large caps are more or less similar to their historical valuation. So to that extent, as things stand today, clearly markets have corrected, valuations are becoming a bit more reasonable, but clearly the sort of a uncertainties where it exists today at this point of a time, purely from, let's say, near term or let's say 6 to 1 year point of view, we are preferring more large caps versus mid caps. But really, one has to take a view of 3-5 years sort of a time horizon. There are enough pockets to really sort of invest into within mid cap space as well. Yeah, no, clearly you rightly pointed out the amount of uncertainties in the form of, let's say, even US Fed rate hike, and then this Russia-Ukraine thing ongoing. I mean, clearly the ideal way is to look into a, I mean, STP sort of a, I mean, way of investing with at any given point of a time. I mean, around 60 odd percent sort of allocation towards, I mean, large cap, and then obviously the remaining could be a pretty good mix of small cap or sorry, mid cap as well as small cap, and and also multi cap. I mean, in basically whichever way one wants to really look look into. So to that extent, I would really suggest that from the near term standpoint, clearly STP is a good approach. Market has already corrected 15% from top, is is factoring in clearly the current situation up to a extent, because see, I mean, again, there might be some bit of a dislocation here and there because of crude obviously going up, but clearly top down narrative for the country like India remains pretty much unchanged, right? So to that extent, this is in fact a pretty good opportunity. Someone who is having a 3-5 years sort of a time horizon, we remain fairly constructive onto the markets. But just purely from the timing point of view, because let's say things are very uncertain in the near term, maybe STP sort of a mode could be a bet. No, so I might not be expert on to this particular asset class as such, but having said that, gold as an asset class typically tend to do well during inflationary times as well as during uncertain times. So that is how I mean, this particular asset class has been doing well since the time of uncertainties has picked up. But having said that, even it looks like. I mean, these sort of inflationary times at least will sustain, and this is more, let's say, supply-led rather than demand-led, and supply-led disruption might not ease out anytime soon. So, to that extent, this as an asset class should do well. I mean, ideally during the near term. Thanks a lot, everyone, and good day. Yeah.